So let's think. The IRS says, hey, well, yeah, we can let them save more, but if their marginal tax bracket is higher, we'd like to collect some revenue now. So if we ignore the fact that it's a tax grab, here's what I think it could be useful for. If you're doing an estate planning move where you want your heir to inherit a tax-free account, then I think that the super catch-up contribution could be useful and the forced Roth mechanism could be useful. Particularly, maybe your spouse inherits it directly after you, they treat it as their own, we get longer time for tax-free growth, and then it eventually goes to the heir. They have 10 years to let it sit there in a Roth account, and then eventually they can pull all that out tax-free.
You're listening to The Pilot's Portfolio, the show dedicated to guiding professional pilots towards a future of financial success and stability. Fly along with your host, Timothy P. Pope, as he provides financial planning insights and answers to your burning questions and dives into real-life stories from fellow pilots who share their successes and cautionary tales. The Pilot's Portfolio takes off now.
Well, welcome everybody to another episode of The Pilot's Portfolio. Glad to have you here. My name is Timothy P. Pope, certified financial planner specializing in the planning needs of the professional pilot. So just as a reminder, the show was previously called The Pilot Money Podcast. And in season 2 here, we've changed the name to The Pilot's Portfolio. So this is the financial show for professional pilots. In today's episode, we are going to talk about what's staying the same and what's changing as it relates to your retirement contributions and your accounts and the updates that we've got on some of the carriers here. And then also, I'm going to share an IRS provision that bugs me, okay, when it comes to your retirement contributions. And this is more so the newer one than the legacy one. So yeah, I'm going to share that. I've been mulling over that for a little while. Maybe I've got an unpopular opinion. Don't know. Love to hear from you guys to tell me what you think. But let's get started with 401k contributions. Okay, so in 2025, the elective deferral, so this is the money that you can put in from your paycheck, has gone up by $500. All right, so not a huge increase, but it's gone up from $23,000 last year to now $23,500. Now, if you're age 50 and older, you can actually contribute an additional $7,500 in your 401k. And remember, this is your elective deferral. This is money coming from your paycheck. You got to go in, you got to figure out what percentage of your pay you're going to put into your 401k. And then you also got to figure out where you're going to put it as it relates to your contributions or how you're going to invest it, I guess I should say. So that has gone up a little bit. United, American, Delta, Southwest, your non-elective contributions remain the same at 17% this year. And each of those carriers are scheduled to go up to 18% starting next year in 2026. Now, Southwest, you guys are getting 1% of your comp in a market-based cash balance plan now, and that's scheduled to go up to 2% in 2026. So in 2026, your Southwest pilots, 20% right out of the gate is going to some type of retirement plan. Now, over at United in the fall, they voted down early implementation of their market-based cash balance plan. So we will see when that comes back online. Who knows? It might take a while. The IRS is never fast, I'd say. So they voted that down. So to be determined when theirs comes back online. If we talk about IRAs and Roth IRAs, okay, so your contribution limits between 2024 and 2025 remain unchanged. It's $7,000 is what you can put in. And now if you're age 50 or older, you can put in an additional $1,000. Okay, so for a total of $8,000. Your IRA or your Roth, these are not connected with your airline. These are accounts that you would open up at a custodian of your choice. You control how the funds are invested. Essentially, you almost have like an unlimited menu of investments that you can choose from inside of your IRAs and your Roth. Now, if you've been listening to the show all last year and you've heard me talk about account types often, you rarely hear me talk about IRAs on the show. And I'm going to tell you why. Okay. So the IRS says that if you are covered by an employer-sponsored plan, so that's your 401k. So if you fly for a major airline, you are covered by an employer-sponsored plan. Is that if you're covered by an employer-sponsored plan and your modified adjusted gross income is above a certain amount, then you can't take a tax deduction. So just as a recap, when we say IRA, I don't lump the IRA and the Roth together, okay? So the IRA is that pre-tax account, so you can put money in, and then when you're filing your taxes, you take a tax deduction, and then sometime in the future, you'd pull that money out and you'd pay ordinary income tax, okay? So the big takeaway there is IRA equals tax deduction, and then Roth IRA equals tax-free income, okay? So you rarely hear me talk about the IRA with the tax deduction here because of that if-then statement that I just made. If you're covered by an employer plan and your modified adjusted gross income is above a certain amount, then you can't take a tax deduction. So in 2025, if you're filing your taxes as single, your modified adjusted gross income would have to be below $89,000 in order for you to take some type of tax deduction in an IRA. Okay. If you're married filing jointly, there's several tiers for you to figure out. But for you, the pilot, the covered spouse, your modified adjusted gross income would have to be less than $146,000 before you get any tax deductions there. So you can quickly see, right? So for the majority of you, I mean, look, if you're single and you're in year one pay, you probably have to start sometime in Q2 to make that work for your modified adjusted gross income to be less than $89,000. If you're married filing jointly and you're the only spouse that has an income, I suppose you could start January 1 and have short call reserve or something the entire year after training and make less than $146,000. Okay, so then it's possible that you could get some type of tax deduction there in an IRA. But then when you look at the numbers and you say, well, where's my earnings projected to go? And where's my marginal tax rate projected to go? Then you start to ask yourself, well, even if I could get a tax deduction in an IRA, should I take a tax deduction now in a lower bracket now and then pay a higher bracket later when I take that money out because I'm going to save well over my career? Or should I pay the taxes now on a lower bracket and then in the future pay no taxes on my earnings, right? And that would be the difference there with the Roth. So you don't hear me talk about it a lot because for the overwhelming majority of you, you wouldn't be eligible to take a tax deduction if you put money in. But let's say you did put money into a traditional IRA. There's no regulation that says you can't, and just says you can't get a tax deduction if you do. So let's say that you do put money into a traditional IRA and you don't take the tax deduction. When you pull the money out later, you would just pay ordinary income tax on your earnings, right? You wouldn't pay taxes again on your principal that you put in, because that's going to come out tax-free. But your earnings is what you would pay taxes on. But that becomes less attractive when you realize, hey, I could probably do a backdoor Roth conversion, or I could put my money in a Roth if I qualify to do that, and then I won't pay any taxes on my earnings, as long as I meet the criteria for the Roth. And so it's kind of what I just spoke about. But so that is why I rarely talk about the traditional IRA on this show, because as a professional pilot and earning what you earn, chances are you probably don't qualify for a tax deduction in a traditional IRA. Let's talk about backdoor Roth conversions for a moment. I want everybody to put a pin in this because in a future episode, I want to spend a little bit more time on it. But with the backdoor Roth conversion in the future, I want to talk about why I still have folks consider that as a saving vehicle, even when I'm telling them they can throttle back on retirement savings, okay? Because the Roth is just an extremely flexible account in and of itself. And we won't get into that in today's episode. I think we should. I think there's enough there for you guys to understand the nuances.
Hey, pilot, are you looking to save 20% on the sale or purchase of your next home? Let me tell you about a friend of the show, Beacon Relocation. With Beacon's exclusive real estate benefit, you can save thousands. My family has actually used their services when we needed to sell a property that was multiple states away. Beacon has over 1,500 experienced agents providing outstanding service and expertise as they guide you through every step of the buying or selling process. They'll even connect you with a national lender who offers competitive rates and discounted programs. As a Pilot's Portfolio listener, you are eligible to receive 20% of the real estate agent's commission towards your closing cost on the sale or purchase of your home. Visit beaconrelocation.com today. Select Pilot's Portfolio via the Apply Now drop-down menu to activate your benefits and make your next move your best move.
Buyer credit varies in some states. Contact us for details.
Let's talk about your HSA for a moment. So this, again, your health savings account, this is the account that is tied to your healthcare plan. So if you signed up for a high deductible healthcare plan in open enrollment and you signed up for then you're eligible for the HSA. And this is a reminder. Now, if you haven't signed up for the high deductible health plan, you're kind of locked out of it unless you have a life event. So that could be marriage, it could be divorce, it could be death of a spouse or something like that, or birth of a baby, right? So those life events will qualify you to retweak your health care. But let's say that you're single, your health plan is for just yourself. Your contributions this year are $4,300 in 2025, so that's up from last year. And then if your healthcare coverage covers a family, it's going to be $8,550. Now, if you're over the age of 55 years old, you can contribute an additional $1,000 into your HSA there. So here's the reminder. Remember that the funds in your HSA can be invested. All right, so you can build a portfolio inside of your health savings account designed to make those funds grow. And that's what makes this account so beautiful is you get the tax deduction on the front end. So that helps your current year taxes. And then you can allow those funds to grow. And then when you pull the money out and you use it for qualified health expenses, then your deduction, but the money that you pull out is tax-free. So that's what makes the account so attractive. And so hopefully while the dollars lived inside the HSA account, they were growing, Now, sometimes folks will ask, hey, how should I be using the HSA? And what I tell them is typically if you have the ability to allow the money to stay in the account and compound in the account, you're going to get the biggest bang for your buck, okay? So that means paying current healthcare expenses from other means outside of your HSA, like your cash flow, like your paycheck. If you're relatively healthy, that could be fairly easy to do, right? If you have frequent doctor visits or your children have frequent doctor visits, that might be a little more difficult to do. But if you need to use the HSA dollars now and you're simply using the account as a conduit, that's okay too, because at least you're getting the tax deduction. So there we go. We've got the 401ks. We had an update on the NECs, the market-based cash balance plans, your IRAs, your Roth IRAs, and why I rarely talk about IRAs on this show. And then your HSA. Now, earlier I told you that I wanted to discuss a feature of the IRS, the retirement saving provision that bugs me. So I'm going to tell you about it now. Now, if you guys will remember in Secure Act 2.0, so that was a couple of years ago now, Congress introduced this idea of a super catch-up contribution. And here's how it works. The regular catch-up contributions, you've heard me talk about it all throughout the episode. So for IRAs and 401ks, if you're age 50 or older, you can put a little bit more money in those accounts. For the HSA, if you're 55 and older, you can put a little bit more money in those accounts there. The super catch-up contribution goes like this. If you're between 60 and 63, you can contribute 150% of the regular contribution in a 401k. And so for this year, that dollar amount is $11,250. But then after age 63, it goes back down to the regular contribution limit. That bugs me, okay? I think I understand the spirit of the regulation. Okay, so someone who is on the doorstep of retirement gets this last chance to stuff money into their tax advantage accounts. Okay, that's cool. But here's the deal. If you're really in a scenario where you're behind on retirement savings and you're concerned about possibly running out of money in retirement, 3 years of contributing 50% more than the normal catch-up contribution is not going to do it for you. Like when you run the math, you're going to be terribly disappointed. So this idea of the super catch-up contribution, it makes me grumpy a little bit, right? It bugs me a little bit because I think it's misleading, okay? Because if you're really in the scenario where you need to catch up, you're going to be looking at several ways to make that a successful retirement, right? You're probably going to be thinking about reducing your retirement expense footprint. You're going to be thinking about how to save way more money than 150% of the normal catch-up contribution amount. And you're probably thinking about how to secure additional retirement income. How can I instruct or how can I do contract trips or what have you? So the idea that that 3-year window it's gonna help, but marginally. But it's not. I think the whole thing is misleading. So I would be, however, in favor of a provision called the get ahead contribution, where between the ages of 30 and 33, you could put in 150% of the normal catch-up contribution. I don't think that's misleading at all, because it certainly, helps you think about and helps you see the power of compounding, over a 30-year period of what those contributions could be. So maybe we need to start a movement there, the get ahead contribution. Now, one thing I will say about the super catch-up contribution that I think could be useful as an estate planning concept or a legacy planning move is starting in 2026, the IRS says, hey, if you're earning more than $145,000, okay, which if you're over 50 and at a major airline and you've got some seniority behind you, you are earning more than $145,000. Okay, so that's you guys listening to the show. They say if that's the case, then your catch-up contributions will have to be Roth. Well, would you look at that? I think that's a money grab from the IRS. Okay, a grab at some tax revenue, because let's remember, Roth contributions, we have to pay taxes today. Number one, if you're 50 and you have some seniority behind you, your marginal tax bracket is way higher than what it was years ago, right? When you were early in your career. So let's think. The IRS says, hey, well, yeah, we can let them save more, but if their marginal tax bracket is higher, we'd like to collect some revenue now. So if we ignore the fact that it's a tax grab, here's what I think it could be useful for. If you're doing an estate planning move where you want your heir to inherit a tax-free account, then I think that the super catch-up contribution could be useful and the forced Roth mechanism could be useful. Particularly, maybe your spouse inherits it directly after you. They treat it as their own. We get longer time for tax-free growth, and then it eventually goes to the heir. They have 10 years to let it sit there in a Roth account, and then eventually they can pull all that out tax-free. Okay, so I could see it useful for a case like that. But outside of that, it kind of bugs me. I'd love to hear what you guys think, because maybe you're thinking about it differently than I am. I think, though, that that's going to do it for us. This is a quick solo episode to talk about what has stayed the same, what's changed. I hope you've enjoyed this episode of the Pilot's Portfolio, and we'll see you on the next one.
Thank you for joining this episode of Pilot's Portfolio. If you found this information helpful, spread the word and share it with a pilot buddy. Or if you have questions and there's something that you would like to hear discussed on the show, send us an email. You can find the address in the show notes. For those of you who are ready to learn how we help professional pilots with their financial planning needs, schedule an appointment. Until next time, keep the shiny side up, and we'll see you on the next episode.
Pilot's Portfolio is hosted by Timothy P. Pope. Timothy P. Pope is principal owner of 360 Aviation Advisors. 360 Aviation Advisors is a registered investment advisory firm regulated by the state of North Carolina in accordance and compliance to the securities laws and regulations. 360 Aviation Advisors does not render or offer to render personalized investment or tax advice through Pilot's Portfolio. The information provided is for informational purposes only and may not be suitable for all investors and does not constitute financial, tax, investment, or legal advice. All investments involve a degree of risk, including the risk of loss.